In this module on inflation, we need to begin with a discussion of the concept of price in economics. Price is looked at from two different views, whether you're a microeconomist or if you're a macroeconomist. In microeconomics, we use price as an allocating or a rationing agent that reflects the scarcity of the good. So you have something which is very scarce, such as diamond, that carries a very high price. You have something which is very much abundant. It carries a much lower price. And the idea is for price to reflect this scarcity. Secondly, what microeconomists do is they compare prices to each other. So you could have, for example, the price of labor, which is called wage, and you can compare it to the price of capital, which is called the interest rate. And by looking at the price of the two of them, you can compare one to the other, and it will help you make allocation decisions on whether you should hire more workers or you should hire more capital. You can also consider this idea of comparing relative prices an opportunity cost. If I decide to do X, the cost to me will be the opportunity lost. That's the relative price. This is all very important and one of the most important things that you will learn when you take microeconomics. But that's not what we macroeconomists are concerned about. Rather, macroeconomists are concerned with what are called general prices. What is the price of things in general? Now, to do this, we have to generate something called a price index, which will sum the price of many goods together. When we pick different categories of goods, such as goods that are consumed only by consumers, we end up with what is called a basket of goods. So in that basket of goods would be energy and food and clothing and housing and so forth. This basket of goods, once we go through the index number process, allows us to actually state the price of goods in general as a number. So the index begins at the number 100. If it goes from the index then rises to 105, we have 5% inflation. What economists have done is we have made different kinds of baskets. We've made different baskets for different levels of generality. We can have the most general case, which is looking at gross domestic product as a whole. And in this case, we have something called the chain-weighted index. And in here, we're looking at the price of just about everything that is purchased within the United States. Secondly, we could focus upon goods in this basket only consumed by the consumers, by the households. And this would be, again, energy and food and movies and doctor's visits and so forth. This basket of goods generates an index number that you probably have heard of called the Consumer Price Index. And then we want to know what is it that firms are facing when it comes to their cost of doing business. So when firms have to buy inputs, if you're going to build a chair and you need wood, what is the cost of the input to the firm? We capture the price of all these different inputs and generate a separate basket different from the other two. And this particular basket generates an index number called the Producer Price Index. Now, depending upon the analysis that you're trying to do, you will pick one of these. There is no one that is better. If, for example, you are a labor union, though, you would pick the Consumer Price Index because you want to somehow connect your wages to the cost of living. But if you're a producer and you want to know how much are things costing me, you would use the Producer Price Index. If you want to make comparisons across countries where you're looking at the price of just about everything that is purchased, then you would use some kind of GDP-related index, the chain-weighted index, or something which is called a price deflator. When you're looking at the question of inflation, you're looking at movements in these price indices over time. Now, economists are very particular when they come to the definition of inflation. Inflation, as you see in the slide, is a sustained upward movement in the general price level shared by most products. So you see, inflation is not a change in relative prices. If you hear that the price of gasoline is rising, this is not inflation. That is a change in the relative price of gasoline compared to other goods. If you hear that the price of computers is falling, this is not deflation. This is a change in the relative price of computers. You have to have a movement across the index, across the basket, that is sustained over time. And this sustained movement of prices in general is what we call inflation. Using the index number is the only way to do this. So we can't look at the price of any single good when trying to generate this thing called inflation. The inflation index that we focus upon mainly would be either the Consumer Price Index, because it affects what happens to households, or we would look at the chain-weighted index related to gross domestic product. When we see the CPI coming out on a monthly basis, including everything that's in the basket, we refer to this particular indicator as the headline rate. The headline rate is the CPI, including all data. However, we do know that within the construction of this particular index, there is a chance that certain goods will vary in price dramatically from month to month, caused by not inflation, but just by changes in relative prices of products that are very dominant within this index. So for example, energy, food, and several other indicators, but mainly energy and food are the two that can have big swings. You can have a freeze in the south, which will take food prices, orange juice and lettuce and other things like that, and raise them dramatically. You can have trouble in the Middle East, which affects the flow of oil, which will cause the world price of crude oil to rise, which will cause your local gas station to raise the price of the gasoline that you buy. Now, this is not going to be a sustained process. This is a one-time uptick in the cost of the gasoline. And then, of course, after the crisis is over, the price of gasoline comes back down. This movement down is not deflation. This is simply a downtick in the price of one component. Now, what happens is that these particular important indicators, such as food and energy, can overwhelm the rest of the index if the movement is dramatic. So what economists have done is we've decided, why not remove the effects of these very noisy indicators, such as food and energy, and come up with an indicator that captures the underlying movement in prices, the underlying trend in inflation, something that is a smooth movement, either up or down or nowhere, a nice flat trend. This particular indicator is called a core price index. The core concept can apply to both the CPI, so we would have the CPI minus energy and food, and then we would also have a core PPI, which would be the producer price index, removing the effects of food prices and the effects of energy prices on the things that the firms have to buy. The CPI as a headline rate is used by most analysts in terms of looking at the actions of consumers. And consumers use it when they're trying to negotiate wage increases and looking at the cost of living. However, this core rate is absolutely essential to policymakers. Policymakers are concerned about the drift or the change in prices over time. They don't want to be misled in their policy decisions by focusing upon a one-time uptick in the price of crude oil, which leads them to fear that inflation is coming. That would be a mistake. So we find that the core index is one used by policymakers, most notably the Federal Reserve. In fact, the Fed is very specific in that they look at the core rate related to the consumption sector of the GDP figures, which does come out on a monthly basis. So if the Fed, the major policymaker on a quarter-to-quarter or a month-to-month basis, is using the core rate, then we have to be aware of that rate to understand why the Fed is doing what it's doing. It is not reacting to major increases in the CPI or major decreases caused by these energy and food price spikes. When dealing in the newspapers and with your analysts and colleagues regarding the concept of inflation, you can understand there's a whole series of terminology, and you want to make sure that you use these terms correctly. So if you see a rise in the CPI over time, remember it is a sustained movement over time, this is called inflation. If you see that the CPI turns down, but does so over a sustained period, not just for a month or two or three, this is called deflation. What can also occur is that you can go into a high inflation period and then this inflation will begin to subside and come down. The most notable time of that was in the early 1980s. Inflation hit around 13%, and it was consistent, and year after year the prices kept going up. And then all of a sudden, because of the actions of the Federal Reserve, the inflation rate began to decline from 13 to 10 to 8 to 6 to 5 to 4. This movement down of inflation is called disinflation. Now, one thing we hope not to see, but there is some fear in the hearts of some that because of Fed policy, if it got out of hand or something happened worldwide with regard to the price of commodities or whatever, that inflation could go into the double digits, 10, 12, 15%. This particular phenomenon in the Western world is called hyperinflation. Now, hyperinflation is very, very rare in terms of most developed countries. Hyperinflation predominantly occurs in countries which have lack of control of the central bank. Zimbabwe is the most recent case where they were having about 1,000,000% inflation per month, not per year. So hyperinflation is a worry, but it is an unusual concept to see. But just so you know, in case we would ever see it in the future, it's hyperinflation. Of all the things that could go wrong in an economy, the worst of all is that you could have inflation that is rising in a period where unemployment is high or rising. Under this case, you have a stagnating economy which can't create jobs, and you're combining it with rising in prices. So you take the stagnation, the stag part of stagnation, you add in the deflation part of inflation, and you end up with an economy that is experiencing stagflation. You want to hope that we never see that again. The last time we saw stagflation, was in the late 1970s and early 1980s. That was a very bad time. You would get 10% raises. And of course, because you had 12% inflation, your real wage was actually declining. At the same time, many of your neighbors were out of work. This was the worst of all possible worlds. Let's hope we never see it again. But there have been countries which have experienced stagflation, and you need to be aware of that particular term. If we're going to have economic data, we always look for some kind of a target. The Federal Reserve, of course, their job is to help stabilize prices. There must be some kind of ultimate goal when it comes to the level of inflation. You'd be surprised and learn, I believe, that it isn't zero inflation. You would think that no inflation is superior. Well, economists have found that that's not efficient. In any given period, there will be the price of some things that will be rising because of simple scarcity issues. Some things will be falling because of the nature of productivity gains. But in general, things will drift towards slightly higher prices over time. Because of that, we have found it is not efficient for the Federal Reserve to try to push inflation to zero. It's achievable, but the costs to society are higher than we would rather bear. A little bit of inflation, as long as it is stable inflation, is not an issue. Therefore, most central banks have decided that if they could get the core rate down to about 1.5% to 2%, they've achieved what they would call price stability. This would translate into a CPI of somewhere in the area of 2 to 2.5%. Therefore, don't be looking for zero inflation. Don't be looking for deflation. What you want is stability. It is the instability of inflation that can be very, very damaging to an economy because it creates uncertainty among decision makers. So you don't want inflation to go from 3% to 6% to 5% to 9% to 2%. This would not be to the advantage of the economy. Even if you go 9 to 2 or something strange like that, you might think, well, this is really good, but not if the firms have already built in a different expectation of inflation. You might also think, is common with many people, that falling prices would be really cool, that what we need is deflation. I assure you that just as inflation eats away at the body like a cancer, the same thing is true of deflation. You might think it'd be great if I could somehow buy things at a lower price, until you realize, well, what if I'm the person on the other side of that particular exchange and my income is falling, but the value or what I have to pay on my mortgage is not? See, that's one of the major problems. Deflation is very, very damaging to people who owe money, because what you do is you owe money in the old value, and when you go to pay it back, the dollars you pay it back with are worth more than they were when you got them. So you and I, most of us probably owe money. We don't want deflation, but we also don't want inflation, because we gain nothing by it. We aren't better off just because things cost more. What we want are stable prices. Now here's one issue we have to face in this particular course in applied macro. There is a definite break between what the theorist wants when it comes to inflation and what the applied economist wants when it comes to inflation. To a theorist, we're concerned with the fine details of economic interaction, which would lead to some kind of change in prices over a long period of time, leading us to this definition that inflation is a sustained upward movement in the price index. But that's not the real world. In the real world, just watch the reaction of politicians, of the Fed, of the average consumer. If all of a sudden the CPI spikes up, they're concerned. Now, this may not truly be inflation because it's not a process. Once there could be these small upticks, and then they disappear because there's not a process of prices rising going on. But you know what? to the average analyst, this does mean something because the market will react to this. So what we have to do is we have to walk a fine line between the theoretician who gives us good ideas on where to look for inflation and the analyst who has to look at the real world and decide what these numbers mean on a quarter-to-quarter or even a month-to-month basis. So think of inflation theory as anything which can explain this upward drift in prices over time. And think of applied macro as looking at the movements of the CPI over time and drawing conclusions about what they mean. Now we're going to borrow from the world of theory and find and realize then what is it that we can look for in the real world to help explain the uptick or the downtick in the consumer price index. One place to look is the supply side. We know that firms have to buy things. And when they buy things to make the product, they will pass these the prices that they have to pay on to you and me in relation to our final price that we pay. So the gas station nearby probably would love to sell you gasoline at $1 a gallon because you'd buy so much more. But they can't. And the reason they can't is because the crude oil, which is the basis of this gasoline, can't be purchased cheaply. For a while, several years ago, the price of crude oil went to $147 a barrel. This took the price of gasoline on the market to its highest in history. This is because the underlying basic resource had become scarce in the market and its price had shot up. When this kind of change occurs in the price or the cost of doing business, the firms will pass on this higher price to you and me. And this is called cost push inflation. Now I did got to get something clear there. There's been a common misunderstanding that if the price of anything that the firm buys causes a rise in the price of doing business, this is cost push inflation. And that's not quite correct, because what it might result in is simply the change in the relative price of that particular product or that particular firm. You have to look at inputs which cross the entire economy, which are so important that it would change the fundamental price charged by most producers. There's only a couple of goods that could lead to what you would call cost push inflation. Most importantly is energy. Energy prices rise and fall, and this can be an engine of inflation through the supply side. Secondly, you need to look at the cost of workers. But even here there's a misunderstanding. Every time wages rise, some people feel, oh, this is going to cause inflation because workers cost the firm more. Not so. You've got to look at that wage in relation to what the firms get from that worker. And this output that the firms get, we can think of it as productivity, the amount of output produced per hour worked. If we find that the amount of productivity rises and matches the increase in wages, this will not be inflationary. The inflation from the labor side comes if and only if the wages that the worker gets go up faster than the worker's productivity. Now this has happened several times historically, and it has led to a labor-related inflationary period. I assure you that sometime in the future, after this course is over, you will hear about workers getting raises, and somebody will set off an alarm that this is going to cause inflation. Please don't fall for that ruse. The first thing you need to check is whether or not those workers are better than they were last time. If the workers have raised their productivity, they're just getting their slice of the pie. This will not be inflationary. Therefore, focus upon large, important, nationwide inputs in terms of cost push inflation. A second source of inflation in the short run is that because of the nature of spending and the nature of production at any given point in time, we can have a disconnect between how much is produced and how much people want to buy. The aggregate demand essentially can outstrip the aggregate supply. And because it takes a while for suppliers to respond, this could go on for several quarters in a row. This will cause the CPI to rise because firms will have the power to pass on higher prices due to this scarcity. There is a disconnect between the amount produced and the amount desired by the market. Again, we always like to have some kind of rule of thumb or something that analysts can look at to find whether or not this demand-sided or this demand pool inflation is called PULL, demand pool inflation. When demand pool inflation occurs, we need to figure out where is it? How can I decide if this is occurring? There's a simple way. If you remember back in the discussion of gross domestic product, We talked about potential GDP and we talked about actual GDP. It turns out that this is the connection we need. If we find over a substantial period of time that the level of real GDP is greater than potential GDP, then you have essentially demand outstripping supply. This will lead to this demand pull inflation I'm speaking of. So anytime this occurs in the growth cycle, you would look at the period above the level of potential. You would look at something called a growth expansion. This is why most analysts say if you're in a growth expansion for a substantial period of time, 3, 4, 5 quarters, this is most likely the sign of possible price pressures, and inflation will be on its way. So this is the place you want to look. Third, in the short run, money is tied to inflation. Now, generally speaking, in Western nations with competent central banks, there is very little direct relationship between the quantity of money and the level of prices in any one given year compared to the money supply that year or the year before. However, if you see a substantial jump in the inflation rate in some location, and it seems to be not rooted in an economy that is doing well, it is most likely due to an incompetent central bank, which is printing way too much money. This is a sign of a country or an economy that is ready to crash. When a central bank loses this kind of control, we have some real problems. But here again, you have to be careful. You do not want to confuse a substantial jump in the CPI in the short run with a central bank in every case. It could be one of these shocks we were talking about earlier when we were looking at core versus headline. If you know for sure that the tick up in the CPI is due to energy or food or some kind of shock from the outside, then you can ignore it. But if there is no other explanation, all of a sudden the CPI is rising, it is because that the central bank has lost control. So a third possible place to watch is the money supply and the central bank. Now, most analysts will try to put all of these indicators together. Some will even add in things like what are called term premiums. In other words, what is the interest rate paid on a 30-year bond versus a 10-year bond? When people have less certainty about inflation, or they believe that inflation over time is going to rise and the average inflation rate over time is going to rise, you'll see the term premium rise. People will have to, the government will have to pay a slightly higher rate on 30-year bonds than they do for 10-year bonds because of this uncertainty. And the same will be true between 10-year bonds and 5-year notes. Another thing that people look at least for short-term movements in the CPI, are exchange rates or import prices. If we have a situation such as a falling dollar, where the price of inputs are beginning to rise, or the imports are beginning to rise, then these higher prices will have to be borne by the consumer. This could cause the CPI to tick up. It can also be if the dollar is very, very strong, which means that these imports are relatively low priced, and if it remains strong for a long time as it did in the 1990s, then we can conclude that inflation is harder to occur because firms can't raise prices when their competitors overseas are keeping their prices low just because the value of the dollar is high. So some people watch exchange rates and others look at all kinds of things, but I would recommend to you that the major thing that analysts look at would be this cost push, what's happening on the supply side, the demand pool, what's happening on the demand side, making sure that the central bank is under control. And then you can watch things like term premiums and exchange rates. When we've tried in the past to take these various indicators and use just one to forecast the level of inflation, most notably money supply, we've been unable to do so. There's been a large error term in our forecasts. For a long time, there was a group of economists called monetarists, and the monetarists were convinced that the sole cause of inflation in all cases was money. And for a little while in American history, it worked out exactly that way. It turns out that that's not the case. Since the mid-1980s, there is not a strong connection in the short run between the changes in the money supply and the level of the CPI. So what we do is we have to make sure that money does matter, and we have to recognize that spending does matter, and we have to recognize that productivity does matter. So what happens is that most analysts look at a combination of goods, and we have also found statistically that if you do a forecasting model that includes the gap between GDP and potential, the level of the growth rate of the money supply, you get a much better forecast of inflation than you would if you focused upon any one particular signal. There is one last thing we need to talk about, and that is the chance that inflation over many years' time will either remain high or will begin to grow and continue to grow. What would be the source of this kind of damaging outcome? Because you're getting the worst of all worlds. You're getting inflation, which is high, which does nothing for you. There's no advantage to prices being high. And you also can get prices rising because they are high to begin with. There can be and is only one source of either sustained high inflation or rising and continuously rising inflation, and that is too much money. If central banks have lost control of the money supply, this will occur. Central banks have an asset, and the number one asset held by all central banks is their credibility. You look at the European Central Bank, you look at the Bank of New Zealand, and you look at the Fed. These are very much respected central banks because they have been able to keep inflation under control. Go back in history and you will find periods where the central banks lost control. New Zealand went off on a socialist experiment, tried to print money to buy whatever they wanted, and completely undermined the economy, the confidence in the economy, the prices were going nuts. It wasn't until they decided to focus their attention on the true nature of a central bank to stabilize prices and foster growth that they got the credibility back. Once they had the credibility back, New Zealand is now perceived as a competent central bank, and we see that their economy is doing much better.